Hi, everyone. My name is Joonhong Kim, a moderator for this panel discussion. I spent 30 years in finance and tech, the last 7 years in digital assets, founding a couple of blockchain companies here in Korea. Before I start, I should confess that I have two phobias, public speaking and English. But anyway, I'll do my best. Let's go. For this special panel discussion, we're actually welcoming two extremely distinguished global leaders who are very difficult to have in one place. They are Fernando Vázquez, president of Chainlink, and Yuval Rooz, co-founder and CEO of Digital Asset. Please give them a big hand. Could you please introduce yourselves and tell us what to do?
Sure. I'm Yuval, as you mentioned, co-founder and CEO of Digital Asset. We created a public layer one called Canton Network. My background is also in trading technology. I was at Citadel and DRW Trading. Got into crypto and digital asset space in 2012, and then started my company in 2015.
Yeah, one thing, Yuval, you made the DAML, right? DAML.
Correct, the smart contract language is DAML.
Most of the Web3 ecosystem is actually doing a Solidity and an EVM smart contract. Could you please tell us the reason why you made it?
Yeah, we needed to create a smart contract language that actually works for financial institutions and not just a funny money language. We'll talk in more details, but when we wrote the white paper for Canton and DAML in 2015, we thought about not just building another layer one for the sake of building another layer one, but actually came at it from more first principle of what do regulated entities need to worry about when it comes to securing their assets, securing their client information. And we just felt that EVM and Solidity specifically were not able to meet those needs, as we've seen with many hacks and information leaking and other fun things.
Thank you.
Thank you for having us. I'm Fernando. I joined Chainlink 3 months ago as their first president. We at Chainlink, we secure around $8 billion worth of stablecoins from a number of issuers. We are provided what we think are the features that you need to have institutional grade stablecoins that support institutional grade use cases. In my previous role, I was the CEO of SBI Digital Asset Holdings in Japan. And in that role, I was quite involved with our friends from Circle, and we helped them bring USDC to Japan. It was a pretty painful journey, so maybe I can share some of the learnings, right?
Yeah, sure, yes. Well, many folks in Korea actually think that stablecoins should float freely on permissionless public blockchains such as Ethereum, valuing the decentralization and anonymity as the most important value. But I have it's just a personal opinion, but I have a slight different opinion on that. For stablecoins, we need compliance, privacy, and interoperability. From that perspective, we have the most important players in the market in this session. All right, first question. And it's a bit stupid. If stablecoin really takes off, do we still need banks?
So I think it's, first of all, not a stupid question, and it's a question that a lot of people ask themselves. Do stable coins, and just generally speaking, digital asset disintermediate some of the existing players. As a former trader, the way I actually look at a bank is a credit extension, right, to clients, and therefore they manage risk. I actually think that stablecoins create opportunities for banks to create better products. Now, I think that there's nothing new, that new technology is going to disintermediate some of the existing players that just don't know how to adapt to new technology. So, as everyone knows, Blockbuster had an opportunity to buy Netflix, and they decided not to. And there is no more, it's only Netflix now. So I just don't think that technology by itself disintermediate. It's the lack of the adoption of the technology that disintermediate. So we are going to see banks issue stable coins. Banks have a huge advantage that their network is already connected to millions and millions of clients that are not just doing payments. They're actually borrowing money for mortgage. They are borrowing money for their business. You still need to know how to manage risk. If you are going to get loans towards your business, if you are going to get loans towards your house, you still need to have institutions that know how to extend credit. Today, it's primarily banks. Tomorrow, we might have new entrants. But I think that banks, if they adopt the technology and kind of lean in, they are actually at an advantage compared to new entrants. And that's why, you're seeing companies like Circle trying to become a payment company. But some of the banks, if you look at JP Morgan and Citi, for example, they're one of the largest payment companies in the world. Now, the question is, and we have a former very senior person from Citi, will these large institutions be able to take advantage of the technology and lean in? Generally speaking, that's the biggest challenge of large organizations, is that from a corporate culture perspective, they're not very good at disintermediating themselves. They're kind of like trying to protect themselves until one day they realize that it was too late. So that's generally speaking the challenge that I see with large institutions.
I'd like to have one comment, you don't mind?
Sure.
Some people don't realize that there are other types of cash on chain. Stablecoin is one example, but there's also JP Morgan, Citi, and others also working on so-called tokenized deposits. Because the fear of the banks is that, if you see outflows from deposits to money market funds, the balance sheet will become smaller, and then they cannot lend as much as they wanted to. But I think the thesis of some of these banks is that, look, if you tokenize deposits, you don't deplete, that part of the balance sheet. And at the end of the day, what I think finance needs is cash on chain, because it enables programmability, composability, you name it. But I see a world where, you look at the taxonomy, we have stable coins backed by money market funds and potentially other assets, and you just have tokenized deposits. At least that's my thesis.
I'll add just to make it a bit more real. So on Canton Network, already today, we are processing close to 10% of the US repo market. So about $350 billion of repo transactions. And as Fernando said, you're going to look for what is the cash leg. I think that the future of stable coins or any type of cash on ledger is going to look like we think about collateral in capital markets. So there's quality of collateral, right? So US Treasury, number one. Then you have JGBs. Then you have gilts, Eurobonds, and they start going down, down, down in terms of the quality of collateral. You could start thinking about stable coins very similarly, which is who is the issuer of the stable coin? And again, this is where I think that banks, whether it's true or not, will have a much higher credit rating or maybe quality of a stable coin, that at the end of the day, if you are a large hedge fund or a large asset manager, you would prefer to transact on chain with those type of stable coins rather than with someone else. But again, I think that this is more of a short-term thing. I think over time, and there's a few very important issuers of new stable coins, as those issuers will show their value and their ability to execute and manage the risk properly, they will become and move higher and higher in that credit worthiness.
Thank you very much. Let's move on to the second question. Actually, we are moving from unregulated to the regulated area of stablecoin. The legislation on stablecoin in various countries is creating another regulatory fragmentation, such as USDC US, USDC EU, USDC Japan, probably in the future USDC Korea. It's the same USDC, but it's different as before. Will it eventually become similar to the legacy correspondent banking model and CLS network, which might also cause side effects such as de-risking, friction cost, and other inefficiency? Or is it still better than what we have now? Fernando, could you start? Yeah, you have the experience in Japan and Hong Kong in Asian countries, right?
Yeah, so the issue in Japan is that you were not allowed to actively manage the underlying. So if it's JPY denominated, you need to put, basically the equivalent amount in cash with the trust bank. That is not generating any yield, no interest payments. You cannot actively manage it. If you bring something like USDC to Japan, even though it's already backed by money market funds in the US, you need to bring, again, an equivalent amount to Japan. So you have like 100% over collateralization. From the point of view of the user, it doesn't really matter. You get what you want, cash on chain. But what happens is that you cannot build a viable business model around it. So the issue becomes the supply side. The end user gets what he wants, cash on chain, but it makes it really painful for issuers and those who want to, again, it will have to effectively subsidize the money market, the stable coin itself. So I see this fragmentation as potentially stifling innovation. It will mean that in many countries you will not have a viable stable coin because there's no viable business model that you can build around it. That's what I see as the main challenge, this fragmentation.
I think a few things. I think that sometimes people think that the risk with stablecoins is that now everything is, they hold, it's fully backed one-to-one. The reality is, and again, this is where I think that understanding the risk framework of different stablecoins, there's still risk. And even the risk is not that the issuer will do something that is not legal, but there's just operational risk. A good example is Circle, which is kind of like considered to be like top of the list in terms of those that do it right, didn't manage their exposure to Silicon Valley Bank correctly, and they could have lost a lot of money, right? So I think that one of the things that we at Digital Asset and Canton Network are trying to do, we just announced about a month and a half ago a partnership with DTCC, where you can actually hold treasuries natively on Canton. So today, most stablecoin issuers hold their reserves off-chain. You don't get to see their reserves as a holder of the coin. And therefore, you are exposed to that risk. You don't actually get to see the reserves. And we're kind of back to today's world where really what you're holding is a liability by an issuer, and you have a lot of trust in that issuer, no different than how you have a trust in your bank to manage the reserves properly. So one of the things that I think we're going to start seeing is the ability to actually see through and to see the reserves in real time. Chainlink issued a product of proof of reserves. Those type of innovations are going to reduce the risk. But at the end of the day, it's important to understand stable coins are not risk-free. And I think it's extremely important. The other thing that I would say is about stable coins, which is related to what Fernando said, which I was very happy because I just I saw the example about K-pop. I think that a lot of people get excited. You look at Japan, for example, they had stable coins for a very long time, but they haven't found the killer use case. And as a result of that, it never picked up. I highly recommend for Korea to make sure that whatever use case that they pick is something that is backed by usage, because what will happen is a lot of energy, a lot of effort will go on in, and then no pickup will happen, and the backlash would be much bigger because it's like, look, we did all of this work, all of this money invested, and nothing came out of it. So I would actually say stay more focused, pick something that will be, success on day one, and then grow from there rather than trying to go too wide.
And actually, I couldn't agree more with Yuval. I think
네, 제가 생각했을 때는 이제 규제들과 그리고 정책과 관련해서 당국에서 고려하는 것이 아무래도 자금 세탁 방지가 되지 않을까 생각이 듭니다. 그래서 저희가 실제로 이렇게 비즈니스
Actual use case, and you don't give the private sector time to innovate. Why? Because they're losing money every time they issue an additional yen. So again, this transparency preferably serve what Yuval and his team are doing. I think can bring this level of transparency that will make hopefully regulators and legislators comfortable when it comes to legislating.
Yeah, even in Korea, we don't have T-bills, which means that the shortest government that is 1 year. So we don't have any non-deliverables. And in formulating the reserve, we also have a problem. Professor Jae-won Chair will address that issue when he's actually doing his speech. Well, let's move on to question 3. Actually, we have observed how dollar stablecoins have rapidly expanded globally, operating unregulated on permissionless public chains. In response to that, major reserve currency countries such as Europe and Japan have swiftly developed relevant regulations to address this issue. Genius law explicitly stipulated a reciprocity, right? But considering the different tax rules, currency sovereignty, a partial currency control, and actually financial stability of each local countries, would it be normal or reasonable for a non-reserve currency country like Korea to adopt the same regulatory framework as the United States and others? Or could there be something to be addressed?
I honestly don't see Korea giving up on their own sovereignty, and certainly, and the currency is a big part of that. So I think we'll keep living on a fragmented world when it comes to legislation, and I think it's up to us to build compliance engines and frameworks that would allow, the financial markets to operate as stipulated by the law. And I think that's doable. Canton has smart contracts. I'm pretty sure you can build the necessary logic around it so that you are maybe a Korean tax resident try to send KRW to me, a Japan tax resident, we do the right thing while following, again, all the strict limits that you impose on your currency. Because that's your decision. It's not the chain's decision.
Yeah, so I mean, we chose the name Canton because in Switzerland, as you know, Switzerland is built from many cantons, that every canton has its own sovereignty and control. Our prediction was that not every country will have its own, a lot of people talk about harmonized rules all over the world. I also like to dream about all kinds of things. It's just not going to happen. So when we build the network, our view was you need to allow every country or even every corporation to be able to set its own rules and then harmonize over one network. So even when you think about the same country, if you're a bank versus a media company, you have different rules that you have to comply with, and you'll have to have different settings of permissionless versus not. And hence the name Canton. I think that there's always going to be people that try to break the rules. I've always advocated that actually blockchain gives regulators better tools to enforce the rules than the other way around. And therefore, again, similar to my earlier point about embracing technology, I actually think that if regulators, rather than being scared that this technology can help people, break the rules, actually lean in and learn how do you actually use this technology to actually enforce the rules better.
That's a really important point to get across. I would argue that the technology to do stablecoins properly is already there. You need privacy, you could work with the content. If you need preferred reserve or on-chain compliance, you can work with us at Chainlink. So the solutions are already there. It's just a matter of sitting down and and creating the standard for the industry.
Yeah. Let's move on to the technology. Right. That's about the technologies that support stable coins. South Korea remains trapped within the dichotomous debate between a permissionless public blockchain and private chains. But for last few years, we've seen something else more advanced and realistic approaches, such as a JPMD or Canton Network, right? Yuval, can you give us about the ideas and the alternatives that you have?
Yeah, to be honest, I just think that this whole permissionless versus permissioned is a bit of nonsense. You know, all these layer 2s that call themselves public permissionless run a centralized sequencer, which effectively makes them into private chains. At the end of the day, even on Ethereum, which is public permissionless, you can build an application where you need to do a multi-sig, and by doing that, you have permissioned the application. So everything you could kind of figure out how to build it the way that you do. The way that we approach Canton is really how do you give the ability for control and privacy, which most chains don't. And you know, last week Ethereum announced that suddenly it took 11 years for them to understand that privacy is important. The problem is that all of these networks built without having privacy in mind, and now they're coming and hoping that they can bolt on privacy as an afterthought. Generally speaking, that's not a good idea, and therefore a lot of times zero knowledge proofs, which I think you called out in the beginning, and I like the distinction that you made, is synonymous with anonymity, not privacy, which again does not work well with regulated institutions. My co-founder is one of the creators of zero knowledge proofs, and we decided not to use it because again, it doesn't go hand in hand with regulation that is much more privacy on a need-to-know basis. Meaning, if I'm the issuer of a stable coin, I need to be able to see all the transactions. If I'm a regulator, I need to be able to see all the transaction. But if I send you a stable coin, Fernando doesn't need to know about that transaction, right? So that's just the way we approached it. You said it's all about the technology. I'm actually waiting for the day we don't need to talk about the technology and we can actually just talk about the business outcomes and the use cases that we drive.
Thank you.
I totally agree with you about this distinction between private and public is a bit artificial. Even public can build an identity and privacy overlay. So again, it's not a relevant point, I think.
Yeah, actually, we'll talk about more about the use cases in session 3's panel discussion. Yeah, but it was a very important comment from both of you gentlemen. Let's go a little bit further into the future, like actually about the real future of digital finance. If you look at a couple of decades in the future, how do you imagine that the stablecoin will bring to the society? I'm really sorry for such a vague question, but I just want to give you a room for creativity.
Sure. I mean, I actually think it's a great question, and I think that we are going to see in the future effectively a real-time movement from any asset to any asset, and no different how cash today is the glue that connects asset, but because of settlement times and rails being separated from one another, the ability to move between assets has a lot of friction. What you're going to see is that friction goes away with stable coins or on-cash solutions being the glue like today, and therefore, you know, you're going to be able to see applications like anytime as an investor I sold an asset, immediately use a stable coin to move it into a yield-bearing product and vice versa. And you know, if you're thinking about it as a financial institution that is doing treasury management, today you have to predict into the future, right? What are your capital requirements globally? Because things don't move in real time. Just imagine if you're a global institution, a global capital markets player that have Basel capital requirements. And now imagine that wherever you have money in the world, you could capitalize your legal entity in real time if you need to. That, in my opinion, on average, translate on average to something like a 20% reduction in capital cost. That, from an impact on the financial market, is huge. It's a huge return for the financial market. So I think this is going to play a significant player with financial institution, even corporates from a treasury management perspective. And I also think that eventually will flow down into the retail customer that will be able to see much more efficient products offered to them.
Kind of adding to that, maybe I will summarize what Yuval is saying with towards mobility and utility. Mobility is these with which you can move the value, potentially cross-border, without breaking the the rules in Korea or any other country that has put some restrictions in the movement of the money. And the other utility piece. Actually, we are working with a name. Fortified company that wants to have exposure to stablecoins. Why? Because once you have the stablecoin, you can easily put that into a yield-bearing asset class. That's something that we learned from DeFi. Of course, in DeFi, many people ignore the rules. It's not regulated. But now we are seeing a number of proper institutional grade DeFi pools pop up. And once you have that, and you can move things in and out of such a DeFi pool that brings you the yield that you might need, or the other way around. I might buy a tokenized private credit fund, and maybe I can send that to a DeFi pool where I can borrow some a Korean won denominated stablecoin against it in real time. No friction.
Yes, it was actually that's all for today, and it was really good to hear from both of you gentlemen, and I learned a lot from you. And I hope this discussion will actually be very helpful for the financial institution players in Korea and the regulators also.
Yeah. You did a great job in English. It would have been worse if we did it in Korean. So nice job.
Thank you. Thanks a lot.
Thank you for having us.
Thank you very much. Please give them a big hand. Thank you.
Thank you very much for such a passionate dialogue and also imparting wisdom on such a timely topic. Thank you very much once again.